As I said before, that today we shall learn together. And in between, after I finish things on my end, then Tatiana and Stefan will be helping you, because I would be expecting that after I finish my lecture part, you do the same exercise which I explained to you now by yourself. Okay. And as I said before, that today the skill that you will be learning, that instead of reading in Bloomberg or in New York Times or any other external report, that how much risk the investor is facing, you will be calculating by yourself. Okay, not hearsay, but things by yourself. But before you go to that stage, which I'll take you soon, maybe in 10-15 minutes, it's very important to know that what type of risk the investors are exposed to. Broadly speaking, the investors are exposed to systematic risk and unsystematic risk. The systematic risk are those risks which come from outside. Outside means you don't have any control over it. If in a country, there's a change of government, and suddenly from a pro-market economy, we have a new set of government who are very left and very socialist, and they don't want too much of market mechanism. They don't want to, they are less pro-capitalist. Then many of the people will not like to invest in that country or in those companies, because people would like to go away, because they think that, you know what, we can be nationalized tomorrow. So why should we have operations? Risk. But it's not that risk which a company can control. There's a change of government. If war breaks out in a country, who will invest there? But can a company, can an investor control the war? I don't think so. If there is high inflation in the country because of some bad macroeconomic policy of the government, or because of some external pressure, there is something, suddenly the Organization of Petroleum Exporting Countries, OPEC, they want to increase the price of oil by 30%. And let's say that in the country where your company is based, produce no oil. You 100% oil you import from West Asia. And over there, the price went up, or there is a bad political climate over there, or whatever happened. Suddenly, your cost of production increases. Your cost of selling the output increases. You are exposed to a risk, but you have no control over it. So systematic risks are like unemployment, recession, inflation, the poor monetary policy, the bad fiscal policies, even epidemic, even some natural catastrophe, even if there is tsunami or any earthquake, like yesterday there was an earthquake in Victoria in Australia. There have been some examples that there have been a lot of nature's fury in Japan. Then there has been some coastal parts of the USA. So these are the things which the investors have no control over. And all these risks, they affect stock market. Question is any technique? Do we have any technique to calculate them, to measure them, to estimate them? That we shall learn today. The second category of risk, and by the way, systematic risk is also called undiversifiable market risk, business risk, or macroeconomic risk. Why it's called macroeconomic? Because basically it comes from inflation, unemployment, recession, these kind of bad monetary policy. The people who are running the country, they don't know what is fiscal policy properly. The country needs to expand economy, and they are raising the rate of interest. Who would borrow from the bank? Bad financial management, bad economic management of the country. It's called undiversifiable risk because even if you are investing almost in the whole market, it doesn't matter. Because every security, every stock is exposed to this risk. It's called market risk because it comes from the market. It's not the risk which is generated by the company itself. It comes from the market. And of course, it's a business risk. And I gave some example that the interest rates, recession, inflation, these are some of the, or for example, if your country's currency's value goes so much down, so much depreciate, nobody trusts your currency. Okay, so this is not the risk which you created. Rather, you are the victim of this risk and you have no control over it. The second category of risk is called unsystematic risk. It's like a homegrown risk. It's a very much risk which is generated by the company itself. There can be two companies in the same industry, in the same sector, next to each other. One company is better governed, better managed, wise people doing R&D, very forward-looking, very innovative, will succeed. Next door company, management, old-fashioned, very conservative. They don't place any importance to R&D, no inventions, no product mix, old, bad technology. Ultimately, they would suffer. Even though they're same sized, same business, same industry, same occupation, everything is same. That risk, which doesn't come from the market, but that risk is generated within the company. That's why I use the phrase homegrown risk. It's generated internally. There are some companies who make huge profits, huge gains, even when there is recession. They make money even during the bad times. And there are companies who become bankrupt even though the market is going up. And this is precisely because of this unsystematic risk. And largely this risk comes from, the bad management, quality of management, bad decision. This kind of risk is also called specific risk. Why it's called specific? Because it is only arising to a specific company, but not the next door company. It's called diversifiable risk because those companies who are exposed to this risk more, you can sell their stocks. So for example, let's say you want to invest in the oil stock, and you see that one oil company is doing better job and other is doing worse. Okay, take the money out of the bad company and invest in the good company. You can save yourself or increase your portfolio. We have a saying in finance that don't put all eggs in one basket, because if somebody tosses them, they all would break before they hatch. So therefore, it's very important that you have a very diversified. That is why in almost every, you read any book of finance, and in the first couple of pages, you will see the word diversified portfolio, which means keep good. Don't invest all your money in one company, in one industry, in one sector, or even in one country. Have a more diversified, rather well diversified portfolio. Diversification doesn't mean that you are investing in two or more companies. If you invest either all your money in Coke or half of your money in Coke and half of in Pepsi, it's not diversification basically, because you're still in the same industry basically. If you invest in let's say KLM, and then you also invest your money into three companies, KLM, Finnair, maybe British Airways. And even though you are in the same industry, in the airline industry, but one good thing is that when you compare with Coke and Pepsi example, your money is now in three countries, even though they are same airline business. 1/3 of your money is in Finland, 1/3 is in Netherlands/France, and 1/3 is in UK. Yeah. So the country risk could vary. So you can escape from unsystematic risk if you are having a well-diversified portfolio. So this is called unsystematic risk, systematic risk and unsystematic risk. And it's not a bad idea to know their synonyms. Another synonym of this risk is called micro risk, because it only happens to the micro unit, the firm, not to all companies. It's a firm risk, it's a unique risk, and it's called residual risk. I will not say why it's called residual risk. I'll explain it. Unless I show you example, I will not say. So I'll keep my mouth quiet about this word, residual risk. When we go to that stage, I would show you why we call it residual risk. But otherwise, if you Google what is residual, the dictionary meaning of residual word is leftover, remaining. Now, remaining of who, from who, that I will not tell you now on purpose. I will not tell now, but slowly I will tell you. Yeah, maybe by next week you will know what it means basically. Then I skip to a few slides and I go to this phrase called beta. Beta is a word that we use for measuring systematic risk. I told you that today you will learn how to find the beta, systematic risk of your company with a real company, real example, real data. And if I can have a quick recall, systematic risk is the risk which comes from outside. It's not your fault. It's coming from the market. You're a great company, great manager, great leaders, great team, great technology, great products, wonderful policies. But what happened? Suddenly, COVID comes and all your plans are basically, they are foiled. They're gone. Everything is gone. Was it your fault? Did you engineer COVID-19? No, it's not your fault. So when you are the victim of circumstances with none of your fault, then it's called systematic risk. War breaks out, epidemic breaks out, there is a natural catastrophe, there's a change of government, there is some political turmoil, there is an army coup in a country, there's a bad economic policy by the state. That is called systematic risk. Inflation goes up, interest rate goes up, the domestic currency's value goes down, unemployment rises. Those risks are called systematic risk. Okay? And the way we measure systematic risk is that you need to know a bit of regression. Can I ask you, how many of you have studied statistics in your previous courses? Basic statistics. None? Say it loud. I'm not asking you to make a give an answer, but I just want to know that how many of you have done statistics in your life ever in school, very basic levels. Okay, well, most of you seems to have done. If you haven't done, not a problem, not a problem. I can share my screen with you. And I can draw the text. Okay. Regression is when one variable depends on the other variable. For example, in this, listen, if you pay attention and don't speak anything, it will be very good to you and to your others, because otherwise you'll be lost. And this topic is very strategic. Once you lose, it's difficult to come back. So just pay attention to it. Y equal to fx. And how we speak it in mathematical terms, y is a function of x. Y is a function of X. And what does it mean in simple words? It means Y depends on X. We see in our life that certain things depend on certain things. I can say that the company's sales depends on your advertisement. The company's sales depend on the advertisement. Your life expectancy, how many years you live, depends on the health in the country. I mean, the health services. The height of the child depends upon the height of the parents. Do you find some correlation? Your kitchen budget, how much you spend in grocery, depends upon your monthly salary. More you earn, more you spend. Your holiday trip, not holiday, your trips abroad depend upon the kind of job you do. If you are working as an office administrator, you don't have to travel abroad. But if you are some sales representative of a company, you have to travel all over. So can you see that one thing depends on other? And I can even say that in many ways, the agricultural production in many countries depend upon the rainfall. The rain comes, the crops grow. Rain doesn't come, crops do not grow. Can you see the dependency? Yeah, same way in the financial markets, stock return depends on the market return, the stock market. I can say stock market. If you don't know what is stock market and stock return, then I can give you one more example. Let's say that we are talking about Microsoft or Apple. Apple stock return depends on, Apple is in the NASDAQ. You know, the NASDAQ is an exchange. I hope you heard of this word NASDAQ. So I can say that the Apple stock return depends upon NASDAQ return. If in a year, or if over a period, 2 months, 3 months, 1 year, 10 years, if the overall NASDAQ market is going up and down, it will definitely affect Apple's stock return also. How is it possible? Well, it can be possible. It's very unlikely that whenever the market is down and your company is making money, and whenever market is up and your company is making loss. How is it possible? So whatever is happening in the market will definitely affect you. Whatever happens in the market would definitely affect you. Effect can be less, more, very much. That's a different, that's precisely we will do. The question is that I'm not talking. This depends on that. How do we measure it? Now, do you understand that in real life, certain things depends upon certain things? Your marks in finance depends on how well you understand, how many tasks you do, how you present, how well you write in the exam, isn't it? Not other way around. You get my point? And this, when we want to quantify, we quantify or we measure or even estimate systematic risk or the market risk with beta, which is like this. Beta, I don't know where to go. But anyway, you know what is beta. Alpha, beta, gamma. I hope you know these Latin expressions. Beta measures the systematic risk. And how do we measure it? If I quickly draw a picture here, If on the x-axis, or first on the y-axis, oh, no, sorry. Great. So if I have text here, let's call it NASDAQ return. NASDAQ return. And then on the y-axis, I take NASDAQ return, and on the on the x-axis comes the NASDAQ return, and on the y-axis, I take, are you talking about Apple return? So we say that Apple return depends on the NASDAQ return, not other way around. You can't say that the NASDAQ return depends upon the Apple return. No, Apple is one company in the whole market. So it's always Apple's return, company's return depending upon the overall market's return. In Finland, we use NASDAQ Helsinki index. Then I can say that Finnair's return or Nokia's return depends upon NASDAQ Helsinki return. And when I draw this picture between what is the relationship between the two, it comes like this. So when I draw the return of NASDAQ and the market, and the Apple, let's say that the line is like this, but the line could also be like this, by the way. The line could also be like this, sorry. The line could also be like this. I have three lines, let's call it one. Let's call it one, let's call it two, and let's call it three. Where do you think that the systematic risk is more? On line 1, 2, or 3? See. Imagine this was the change. This was the level of NASDAQ return. And then next time, the NASDAQ return jumped to this level. Look, here, when there is same change, certain change on the x-axis, there's a very small change in the line 1. Look, the jump is very small. In second line, the jump is big. Third line, the jump is even bigger. Can you see the difference? This is measuring systematic risk. Okay, forget about statistics. In mathematics, you must have done the equation of straight line. In the equation of straight line, we measure a concept called slope. Slope. The line which has more slope, can you see which of these three lines has more slope? Third one. And which has the least? The first one. The line which has almost flat trajectory has the less slope. And the line which is very close to almost vertical axis, that has the high slope. And how do we measure it? Well, I have to draw this thing on the board, but Tatiana, can you write that thing in the chat? So slope basically is equal to, if I have y and x, then I can say that if this is the NASDAQ return, let's say today is 22nd of September, but on 22nd of August, this was the stock, this was the market NASDAQ return. And when this was the NASDAQ return, Apple return was this much on 22nd of August. And now on 22nd of September, you can see, can you see the change here? Can you see a triangle somewhere appearing? Can you see that this green thingy is like a triangle? Yeah. Can you see that? And this diagonal, we have the base, we have the perpendicular, and then we have this hypotenuse, this diagonal. That is measuring the slope. So I can say that this is change in X and this is change in Y. Delta Y, if you can't find delta symbol, you can write delta in English in the chat. So it means that the slope is equal to delta Y. So I can say that, okay, I can write down maybe. How do I get this text? Okay. So slope is equal to,
I can put a video on this.
Change in Y divided by change in X.
And let's say,
now it's fine. I think change in Y, change in X is showing up. Yeah.
Yeah.
I can just go into
All right. All right. Okay.
Good.
Good.
Is it visible?
It's fine.
It's fine. I'm recording. Carry on.
Yeah, let's not go into the intricacies.
Let's say we calculate and we find out that this is equal to 1.23. Let's say that it comes out to be 1.23. Let's say the beta is 1.23. So basically it means that if there is a 1% increase in the NASDAQ return, in the market return, the Apple return will increase by 1.23%. Investors are very happy. Hey, market increased by 1%, and the NASDAQ and the Apple return increased by 1.23%. But you know what? There's a downside effect also. But there's a downside. The downside is if the whole market goes down by 1%, then Apple return will go down by 1.23%. So in the good times, it's really good, but in the bad times, it's really bad. In the good times, you are better off than the market. But in the bad times, you are worse off than the market. So can I also say that beta shows sensitivity? How sensitive the company's stock is to the market. Higher the beta, more is the sensitivity, and more is the risk. Risky stock. Okay, before you serve your client, hey, would you like to invest in this company? And you do this calculation, beta 1.23, and you show this calculation and explain to your clients. If they are risk averse, if they hate risk, you know what? They would never choose this company. They would never choose Apple. Because look at that, 1.23. It's very big. Risk averse people, they hate risk. They want to play safe. But if you are a risk lover investor, then Apple is a choice for you based on this imaginary number of beta equals to 1.23. As a rule of thumb, it's not a theory, but just as a norm. If you are a risk averse investor, then usually you prefer beta 0.8 or below. And if you are a risk lover investor, then you prefer beta more than 1. And if you choose between 0.8 and 1, that is called that you are a risk neutral investor. Risk neutral means you may take some calculated risk, but not too much.
Excuse me,
High
Shab.
risk, low risk, and the medium risk.
Shab asked.
So this is the basic idea of beta, that how we treat beta. Now, what I'm going to do is, I will take you to the real life situation, and we shall calculate beta. Are you ready? Good. I will take the example, for example, I'll go with, let's say, I'll go with Nokia. I go to a very famous, very commonly used website in Finland or in the Nordic country called NASDAQ-OMXNordic.com. And I would share the link with you in discussion forum. I go there and I click shares. Yep. And then I click historical price. Historical price. And here I look for Nokia. And I find that Nokia is listed in Swedish kroner. You can see SEK. Yeah. So Nokia is listed in the Stockholm Stock Exchange. And Nokia is also listed in euros in Helsinki Stock Exchange. So I took euro Nokia, yeah? And then I get some information about Nokia, but that's not what I need. That's not what I need. I don't want graphs. I want data in Excel. Yep. And here, okay. Just a sec. So I'm not sharing the screen, yeah? Actually, I can click screen so that. Now, can you guys see in the screen?
Yeah.
Okay. So we are in Nokia. And then I click the historic prices of Nokia. And let's say, you can see that the from date and to date. Today is 21st of September, 21. I don't know why, but it shows that there is a 20th of August. I keep 20th of August, I have no problem, but I want to go back to 19. So I want to have at least 2 years data. I want to see that how much risk is associated with Nokia for the last 2 years at least. So what I do here, I put 19. And then you can see that the graphs are changing, but once again, I have nothing to do with the graphs. I want the data. I search for it. And I know that there's a download to CSV function, okay? And I click download to CSV. And now I see that some Excel is showing up. Come on. Oh yeah, here we go. And you can see that can you see Excel in your screens?
Please remind me if you can't see it.
Maybe it's visible.
Yeah, always. So otherwise we will miss the dialogue. And you can see that there are many words, opening price, high price, closing price, whatever. I will explain these things some other time, but today I only focus that, look at that, 21st of September today, yeah? Or yesterday, because today's market is still on. And then if you go back, the last date is 20th of August 19. And you can see that there are about 525 observations, yeah? Because on an average, in a year, we have about 250 working days, 365 days, and then minus 104 weekends, 52 weeks times 2, and then plus other holidays. So on an average, we have 250 working days in a year, and you can see that we have about 525 working days data. So that's fair. Now, I delete all columns because, as I said, I'll explain them some other time. But I keep only one column with me. And that is called closing price. And I say Nokia closing price so that it becomes very clear what I'm talking about. So let's call it Nokia closing price. Yep. And remember, in the example which I showed you, did I say stock price or stock return? Do you remember? Do you still remember? Did I use the word stock price or stock return? Return. Why did I say return? Why not stock price? Because the price itself doesn't show anything. Imagine the price is 20,000 on day 1. Day 2, the price is 20,001. Yeah. On the other hand, the price is 2 euros and next day it goes to 3 euros. Where do you earn more? Imagine on day 1, in one case, the stock price is 20,000. Day 2 is 20,010, let's say. Whereas in one example, the other example, the stock is on day 1, 2, and day 2, 3. Where do you gain more? Huh? Why so?
If you divide 3 by 2, the result is a little bit higher than 2010 divided by.
You get 50% increase in a day. 50% increase. Look at this change. 50% increase. And look at this. 10 divided by 2,000. 0.5%. 0.5%. So the value, the bigger number doesn't mean that you gain more. Are you with me? The bigger number does not mean that you gain more. And smaller numbers do not mean that you gain less. This is why in the financial markets, the first lesson you learn, if you want to show your performance, never show your performance in terms of absolute price. Show in the relative numbers. And the relative numbers are stock return. So stock return is a relative number. So we always check our performance in terms of our relative numbers. Okay, so we want to calculate Nokia return. But the problem here is not about financial thing, but there is a thing about my Excel doesn't work if I have commas, okay? So what I'm gonna do is, I don't know about your computers, it's about setting of the computers, okay? So what I do here, and this is not something which you have to do as well. Maybe your computers are compatible, are fine with the comma. My computer is not. So what I do here, I go to home, find and select. Oh, nah, not this one. Find and select. Where is find and select? Ooh. Go to home.
Let's go one more time. On the ribbon. Yeah.
Okay. Find and select. Replace. I want to replace comma. I don't want to have comma at all. Replace comma with nothing. So just press enter. Nothing. Replace all. Okay. Commas disappear. With the numbers, okay. And then I want to calculate the return. Hope works. Return is equal to stock price today minus stock price yesterday, divide by stock price yesterday. Okay. Some numbers are not having value. It could be. Sorry, yeah. So we can find that the Nokia return is showing up. And how we calculate the return? The return is equal to the current price, and always use the bracket. If you don't use the bracket, it will be totally wrong. Is equal to start brackets, the current price minus the previous price, divide by the previous price. And when you click enter, you calculate it. And if you find this thing, then it goes all the way down. You don't have to calculate for each cell. It just goes down, drag it down. And why it's so? Because when I asked that, when the price jumped from 2 to 3, the lady over there answered me that there's a 50% increase. And how does she know that there's a 50% increase? Because when the new price is 3 and the old price is 2, and then you divide by 2, it comes to be 0.5. And 0.5 means 50%. Make sense? So I'm using the same logic in Excel as well. Nothing has changed. Good or not good? Are you all fine? So this way, we can calculate, we can convert the price to return, and that's what we need. But now we're still missing one thing. We have the company return, but we don't have the market return. Are you with me? We have the company return, but we don't have the market return, but not a problem. Let's go back. Let's go back and go to, let's go to our page. Can you see the screen here? Yeah. Please remind me if you can't see it, because otherwise the whole discussion would be lost. Now see what I do. Earlier, I was looking at the shares, yeah? Now I look at the indexes. And I'm taking Nokia Euro, and you can see that there are top index values here. Because I'm taking Euro values, so I click OMX Helsinki 25. OMX Helsinki 25 is the index of 25 biggest companies' average price movement in Helsinki Stock Exchange. Yeah. So what I do, I click OMX Helsinki 25. And then I go to the historical prices. as usual, as before. And historic prices, yeah. So you can see that the dates by default are same, but all I need is that I need to change the year actually. Same period. Remember I took 2019, right? 20th of August, 29 till yesterday. And then I search for it. And then I see the values. Do I see the values here? Look, all the way to 20th of August 2019. So I think what I can do here, I can copy and paste straight away from the page. And go all the way down. It won't take too long because it's only 2 years. Yep. And then I copy. And then I go to the spreadsheet. And I paste the values here. Dates are same. Well, I can write date, no problem. And I think the only value which I need is the last value, because that shows the index value, closing price of the index. This is the closing price of the market, 5404.69. So I go back again to the share screen, or maybe it doesn't matter. And here, because I've been fine, so there are some decimals, so I want to get rid of these decimals first. So perhaps what I can do is, I don't need this column, so I delete it. I only need the last column, so E and F I can delete, no problem. And the last column, this is the market. This is the Helsinki 25 index value, the market value basically. Okay, but the problem is that now I have this decimal thing. I want to get rid of this decimal because I can't do with the comma and decimal together. So what I do here, I think I should use this replace thing. So I replace decimal with nothing, basically. Replace all. But the problem is that there is now extra space. So I replace extra space with no space. This space has actually increased. So replace double space with no space. Let's see how it works. Okay, now I'm resuming the recording. So you can see here that we have the Helsinki index value, and then we have the Helsinki return value. So I call it Helsinki RET, return. And in the process, I ignored some of the decimal points, and that will not make any difference because we are not taking the absolute values. We are taking the relative value. So whatever approximation we do in the top value would be matched by the bottom value, and that thing will not make any much impact. So now we have the two values, and we know that we have 525 observations. And now I think hopefully we are in a position to calculate beta. And how we calculate beta, it's very simple. Excel goes with the same way as we discussed in the theory. In the theory, I use beta with the word slope. Can you see the word slope? So what I do here, I write slope, choose the sign, and you can see that Slope says take the y values first and then take the x values. Y values means the variable which dependent variable, and who's dependent? Fin-Air return is depending on the Helsinki index return. So X is the Helsinki index return and Y is the Nokia return. So what we do now, we can pick up the Nokia return, only take the values, not the text. We take 525 values. That's what we plan to take, because that's for 2 years. 525, not the last value. And then we separate by a semicolon. Sorry, we separate. I'm sorry. So the first slope doesn't matter. This start from C2. I can even do this way: C2 to C525. Semicolon. F2 to F525. If I want to close the bracket, it's my choice. I click, it's 1.23. Hey, it's 1.23. Can you see that? I just accidentally or incidentally, I chose beta 1.23 in the example. Do you know that? It comes out to be exactly 1.23 here. So it means the beta of Nokia is 1.23, or if I approximate, it's 1.23. So beta is 1.23 of Nokia. Now, what does it mean? It means that whenever all the companies' average return in Helsinki 25, average of 25 companies, top 25 in Helsinki, when it goes up by 1%, when it goes up by 1%, Nokia's return goes up by 1.2%. But if the market goes down by 1%, then Nokia's return goes down by 1.23%. Hence, Nokia is meant for risk lover investors. If you are a risk averse investor or even risk neutral, because risk neutral can go up to 1 beta. But here your beta is now here beta is 1.23. So Nokia is not meant for soft-hearted, tender-hearted people. Nokia is meant for people with very strong heart. They can bear the shock. Because if market goes up, the upside is 0.23, more than 23% more than the market. But if the market goes down, you lose 23% more than the rest of the market. So both upside and the downside are huge. So the fluctuation can be very big. This is a measure of systematic risk. Whatever happens in the economy, inflation, interest rate, fluctuation in the whatever policy, they all are reflected on the company stock return, and they all reflect on the market stock return. And when you combine them together and just use one basic Excel function, I could have done it with SPSS also, but not everybody has access to SPSS, but Excel is something very basic tool for everybody. It's very much doable. Okay, and we find that the overall macroeconomic fluctuations are reflecting through beta. And just go with the rule of thumb, beta below 0.8, risk haters, risk averse. Beta between 0.8 and 1, risk neutrals. Beta more than 1, risk lovers. That's it from my side. Questions, comments?